Hello, everyone. So today's session, what we are trying to discuss is regulatory treatment of fair valuation gains and losses. So what our purpose is basically to understand how fair valuation gains and losses are treated for regulatory purposes. However, we are not restricting our discussion only to understand what is the regulatory treatment. We would also be understanding what is Ind AS basic financial statements look like in the Ind AS, and also the concept of financial instruments and how they are accounted for. So first part of this particular session that I would say, the first video would be basic understanding of Ind AS to enable understanding of financial statements. So when you see a financial statement, you're able to understand how the financial statement looks like, what this particular figure means. All this would be covered in the first part. Another part would be understanding of financial instruments. So what are financial instruments? How are they accounted for? What are the different classes of accounting financial instruments for accounting purposes? These all would be covered in the second part of this video itself. So these two would form the first video. In the second video, what we would discuss is the regulatory considerations. That what happens to the fair valuation gains that arise from the dividend declaration, bonus issuance, calculation of managerial remuneration under Section 198. So first part, when you talk about, it's mostly how these fair valuation gains arise, why are these fair valuation gains, how are they shown into the balance sheet, how to trace them. All this would be in the first video. The second would be their considerations for the regulatory purposes. Going ahead into this video, first what I would like to discuss is the Ind AS financial statements. So what is Ind AS basically is adoption of IFRS into India. So IFRS is a globally recognized accounting standards. We wanted our accounting also be convergent to such IFRS standard. So hence we brought in Ind AS. The Ind AS was highly convergent with the IFRS. Not exactly same as IFRS, but it's more or less entirely same with IFRS. So this particularly enabled the entities to make their financial statement more comparable to their peers into foreign countries, as well as their subsidiaries or holding into the foreign companies. So it was a pretty much welcome move by the entire industry. It though created some difficulties in adoption accounting perspective, but that change was required. Uh, that moving out of the comfort zone was somewhere necessary. Another point to note over here would be the Schedule 3. So most of you might be aware that the format of balance sheet and P&Ls come for companies come from the Companies Act 2013. So even the Companies Act 2013 was amended to provide for formats specifically for the Ind AS compliant entities. So when you talk about this particular balance sheet and P&L, the format would be as per Schedule 3. However, the Ind AS, the figures, calculations, determination, what would be carried to P&L, what would form part of your income, what would not form part of your income, that comes from Ind AS. Now, financial statements, when you talk about what consists of financial statements, comes to a major question. Now, generally, you would see that balance sheet, statement of profit and loss account, changes in equity, cash flow statement, notes to account were there previously also, were there in days also. However, an important consideration or an important new point that discussed at this stage would be introduction of other comprehensive income. So what is other comprehensive income? Other comprehensive income is basically a part of profit and loss account. So profit and loss account, when you talk about, it is divided into two parts. One is, of course, the profit and loss account. You know what is the revenue, then you minus the expenses, you get the net profit. However, there are few items, to be precise, 9 specific items in which you want your P&L account to not reflect those changes. You want your net profit to be unaffected. You do not want these items to affect your net profit. However, you do want these items to be disclosed to the stakeholders. So these particular items come under other comprehensive income. We would discuss a little bit about what is other comprehensive income, why it's formed, what was the purpose of bringing it in. Basically, why other comprehensive income was brought in was that I want, as I mentioned, there are some items that I want to be shown to my stakeholder, but I don't want my P&L to be impacted. Those items come under other comprehensive income. Now, there are few items that are specifically permitted, some are required, some are optional, that goes into 9 specific items. That is Ind AS considerations that are accounting purview. That is not the main topic of today's discussion. However, few points that I would like to note at this stage is that other comprehensive income, though it is termed as income, is not necessarily income. It is more or less a statement. So its balance can be positive or negative. Another point, not to be confused with net profit or operating profit, operating income, operating loss. Operating income, that's a different concept altogether. When you talk about other comprehensive income, it is outside the net profit. Operating or non-operating both form part of your P&L only. But other comprehensive income outside your P&L. We will see how it looks like. We will also see some financial statements to understand it. it does not impact your revenue. And however, another point, very important point that I would deal in detail further would be that other comprehensive income does form part of your equity. So your equity is getting impacted by it. Here I have a publicly available financial statements of HDFC Limited. So this is available on a public domain. You can just go and check it out. Yeah, one important thing that I would like you to notice over here is that this is a simple P&L account. So above it is the revenue, expenses, all that income, not of much concern over here. After all this consideration, what we get, the important part over here is the net profit. So this net profit after tax, this is all of you might be aware that your revenue minus expenses, you get net profit after tax. However, there is another adjustment done to this net profit after taxes, that is other comprehensive income, right over here. Now, when you see that most of the figures that you will see is the net profit. So net profit here is not being impacted by it. And another line, and it's an important term that I would like to notice here, is another line below the net profit. Hence, you also call it below the line items. The items that do not affect your net profit are called below the line items. So there is a line below, you would see other comprehensive income. So the balance of other comprehensive income, then you get the total comprehensive income. This is how generally it looks like. This is a notes to account statement just for a better understanding. Another point that I was previously saying is that my net profit was not impacted. Here you can see clearly that your net profit is not impacted. But one thing that you should notice at this stage is that this profit, though, does not affect your particular balance for profit and loss account, it does affect your equity portion. So here you would see that your reserve and surplus accounts over here are there, your equity balance. So when you see the final equity balance, the other comprehensive income is impacting your equity. However, it is not at all affecting your net profit. So this is a little bit element that is different from the profit and loss account. This was the first part of the discussion. What is how the financial statement looks like, other all items, balance sheet, you all are very well aware. I'm not getting into understanding of the balance sheets. Other comprehensive of something I dealt was new, so I have dealt in detail. Next part of this video that I would like you to understand is financial instruments, accounting of financial instruments and their treatment for accounting purposes. So once before we dwell into regulatory regimes, we should of course have an understanding of what are financial instruments, how are they accounted for. Financial instruments are what? Basically, financial assets and financial liabilities are collectively known as financial instruments. So now, again, just a collective term for financial assets, financial liabilities, but just note this term financial instrument is for both asset as well as liability. When you talk about what is financial assets are general assets like cash, investment in shares, receivables. Of financial assets, the name itself suffices the meaning. That what investments in bonds and debentures of another entities, derivatives, all this come under financial assets that are on the asset side. So my investments basically, I might be holding some cash, I have invested in some equity instruments, I have some receivables. These all come under financial assets. What is financial liability on the other end is that a contractual obligation that I have to pay out, my debt instrument. Now here, one important point that I would like you to note is that when you talk about asset side, all the financial assets are covered. However, on the financial liability side, there are two portions. I mean, I'm not saying about financial liability. A normal asset and liability side, if you see of a balance sheet of an entity, there will be two portions. One is equity, another is liability. So this financial liability only covers the portion that is other than equity. So asset side, all the financial assets are covered. Even your equity instruments are covered under financial assets. But the equity that you issued is not covered under financial liability. Financial liability is different. Financial liability mostly pertains to debt type instruments. So if you take a broad consideration, debt and equity, financial liability will be more akin to debt. It's more like a debt capital. Equity portion, that equity that you've issued is not a financial instrument. Our equity that you've invested in is a part. Now, an important point to discuss now would be what are the different classes of financial instruments. So when you talk about accounting of financial instrument, what Ind AS 109 requires us is to distribute or classify these financial assets into three different classes. What are these three different classes? First is amortized cost, fair value through P&L. Another is fair value through other comprehensive income. We would classify the financial. Now, here you should note that the financial instrument is being classified. So both financial asset as well as financial liability is being classified. What would be the classification? When would a financial liability fall into which category? When will a financial asset fall into which category? We will discuss it further. Here at this stage, what I would like you to understand is that there are three classes: amortized cost, fair value through P&L, fair value through OCI. Once we have determined under which class this would form or it would fall, at that stage we will decide how this will be accounted. So this classification would decide how this particular instrument is accounted. If it falls under amortized cost method, what I will do is I will amortize, as the name suggests, I will amortize the income or the expense, whatever it is. If it's the liability, it will be expense. If it's the asset, it will be an income. If it's the income or expense is carried to my P&L account based on amortization base. So what I will do is I will draw the cash flows from that particular asset. I will discount it, or I will rather take out an IRR that in accounting terms we call is EIR, effective interest rate. It's exactly same as IRR. Now we take out that IRR. Based on that, I will just keep on amortizing over the tenure of the asset the particular income or expense to my P&L. That is amortization cost method. For the general treatment, where our main intention is to discuss it regulatory purposes. So for regulatory purposes, there is not much to discuss in amortized cost. What impacts most would be the fair value through P&L or fair value through other comprehensive income. At this stage, I would like to tell you a simple example. Like a company invested into a equity shares of say 10 rupees. So it bought a share of 10 rupees. Today, at the reporting date, when it's preparing its financial statement, the price of the share increased to 12 rupees. So basically, the company made a gain of 2 rupees. What Index requires that this particular investment that you're is currently fair value 12, though you have not sold it out, you're currently holding it, should be accounted for at 12 rupees to show the true picture. Now, it might have gone to 8 as well. To show the true picture, what is a true standing at today's date, you should account a particular financial asset at fair value if it's required. When it will be required, I will discuss it going further. Now, if it's required, so once the financial asset is fair valued, the particular fair value, that is the asset would increase from 10 to 12. That is done. Now, once the asset is increased from 10 to 12, this 2 rupees gains, how would that be represented into a financial statement? That is what depends whether the asset is classified under FVTPL, that is fair value through P&L. So if in case it's FVTPL, the profit will go to profit and loss account. However, if the instrument is accounted to other comprehensive income, the particular gains would go to OCI. OCI, we already discussed what it is. So either it will go to P&L or OCI, depends on the classification. So first we will determine what the classification is based on the test that we will discuss further. And once we've decided the classification, the manner of accounting would follow. Till here, I think it should be clear that main thing that I think you should carry from this slide ahead is that if there is a fair valuation gains and an instrument is accounted in the fair valuation method, and if there is a gain based on the classification, the fair value will either be carried to P&L or OCI. From the last slide, in continuation to the last slide, in this slide, what we would like to discuss is when does a financial asset or liability classify under which category? So how the classification happens? When will a financial liability go under any of the classification? Where do the asset go under any of the classification? First, on the simpler part, how are liabilities classified? As a general rule, all the liabilities are classified under amortized cost method. So basically, the method I already told you, take out the effective interest rate, you amortize it over the tenure. Again, a point to note over here, this is not applicable for the equity portion. You're not amortizing your equity portion. This is only for the debt portion. And what is equity and what is liability? This is again separately defined under Ind AS 32. Liability part is very simple, but however, if you have incurred a liability for trading purposes, in that case, it goes to FVTPL. In a general manner, you can say that liabilities always go to amortized cost unless for trading purposes where it will go for FVTPL classification. That is as much as there in the financial liability side. However, when we talk about financial assets, the classification is much more detailed. There are basically, I say, a two-step test that we can say. First, what we would do is check the characteristic of the financial asset. First, I will try to understand what is the financial asset, what are the characteristics, how am I going to earn from it. That is the characteristics of financial asset. First, I will check that. Based on that check, I will determine. Then second part that I will consider is what is my business model. Whether my business means why am I investing in it? What is my purpose to it? So two things to consider: what is the financial asset, what are its characteristics. Second part would be the business model. Why am I investing in it? These two, based on these two elements, I would decide whether a particular financial asset would be under amortized cost method, FVOC, or FVTPL. The first is the characteristic of financial instrument. I only have to check one thing: whether the cash flows that I'm receiving from these financial assets are in the form of payment of principal and interest only. So if say you invested in a bond, I would take a simple example. You invest in a bond in which the bond would pay you monthly interest, and at the redemption time, it will pay you the entire principal amount. In this case, it's a clear case where you're saying that all the cash flows being received from this particular bond will satisfy this test. It's for all the cash flows that you're receiving are for principal and interest only. So here I will say that the SPPI test is satisfied. However, if you invest in equity, your cash flows would not be in the form of principal and interest. You would not get any principal payment outflows. What you would receive would be simply a redemption price, or what you call a sale transfer price. Redemption would not happen. You would say a sale price when you sell it off. The entire price you would receive. So it will not satisfy. So in case a particular instrument or a financial asset does not satisfy the SPPPI test, what we will do is we will account it under FVTPL method. This is a simple rule. First, check for the characteristic of financial asset with whether it is a SPPI test satisfied. If the SPPI test is satisfied, simply go and classify it under. If it's not satisfied, simply go and classify it under FVTPL. However, there is a special carve out given to equity instruments, where equity instruments you can go, if you have invested in equity instrument, you can irrevocably choose to account under FVOCI. To take a pause over here, I'm repeating myself. If SPPI test is satisfied, you will go and check the business model test. Now, what is business model test? I will discuss further. We will discuss what is business model test. You will need to go to step 2 only once the SPPI test is satisfied. If the SPPI test is not satisfied, simply carry those investment at FVTPL. However, if those investment that did not satisfy the SPPPI is an equity investment, in that case, you have an irrevocable option to classify it under FUS. What do we mean by irrevocable option? That once you choose it, you cannot change it. You would have to carry it for as long as you hold it. This is if you don't satisfy. If you satisfy, then you come to the second step that I said, that why had you invested into this financial asset? I will ask you another question. Why did you? First, I ask you, is the SPPA test satisfied? Yes, yes. My instrument, I have invested in a bond. My SPPA test is satisfied. Then I will ask you another question. What is the business model? What is the purpose? Why are you investing in this asset? So there can be 3 answers to it. First, you say that I will hold this investment till the maturity. I will hold it till maturity. At the redemption, I will get the payment. I will get my coupon payments. That is what my intention is. So I say that when you're saying that you will hold it till redemption, you should also recognize your income till redemption. Your payment, your income would come in the form of payments only. So those payments you recognize as the payment of income. You take out the IRR. So hence go for amortized cost method. If you want to hold, if a particular instrument satisfies PPI test and you're wanting to hold it till redemption, and what we call is hold to collect model, that your intention from that is to collect the cash flows. That is the main purpose. That you say that you will account it under amortized cost method. However, if you go give me answer, no, I am not interested in holding it for such long time. I would just simply invested in it. I will take some time. There might be some fluctuations into the market. I will get a good opportunity. I will sell it off and get out. At that, Simon saying that what your intention is the trading purpose. So I say it hold to sell model. What your business model is hold to sell. That I am holding it just to sell it off when the opportunity arises. In that case, I would say that see where how are your gains going to come in? Your gains would be in the form of cash flows that you get at the time of. So any changes into the market would impact your earnings or your losses. Hence, any such changes go to FVT, should go to your profit and loss. It makes sense that if you are for trading purposes entering into a transaction, the fair valuation gains or losses would very soon be realized. Hence, your PNL should take an impact or hit at this stage only. Hence, we will account it under FVTPL. Any gains or fair valuation losses would be under FVTPL. Yeah, an important point to note is if the fair valuation gains is accounted for under FVTPL, these gains would impact your net profit. However, if you go to FVOCI, of course, if it's an equity instrument, you have a different option, a equal option, but we are not talking about that. We are talking about instruments that the SPPI test is satisfied. However, there can be another situation where you say that neither I have entered this for a trading purpose, neither I'm intending to hold it till maturity. I'm indecisive. In a layman's term, I can say I'm indecisive. I might hold it till the end, or I might sell it off. It depends on what market opportunities I get. In that case, we said that it won't be very prudent to take these gains to your PNL. Neither would be very prudent to account in the amortized cost, because accounting for amortized cost over the period, you might not even hold it till the end. You might sell it off in the between only. So we said in that case, the best method would be go for FVOCI. Your PNL would not be impacted, but your equity, your shareholders would know what their real position currently is. Hence, in that we call it hold to sell model. So these tests are over here satisfied. here we have given a simple graph that pretty much summarizes what I told in this. What we discussed in the previous slide, another chart, because this is a little technical, so I thought a second discussion would be helpful. If it's liabilities, it's held for trading. Yes, you go for FVTPL. If it's not held for trading, any other liabilities, just simply go and account it in the amortized cost method. No second consideration. Go and account it in the amortized cost method. Now coming to the financial assets. Now, when you talk about financial assets, derivative is simple. It's mostly accounted in the FVTPL method directly. No much discussion around that. However, there is hedging. Hedge accounting is a separate topic. That's a pretty much detailed topic that is not a topic for today. So I'm not getting into it. A general derivative that's not for hedging purposes is accounted under FVTPL method. Now, when you talk about, there are two: debt instruments or equity instruments. Equity instruments, I already told you. There's a simple technique. Equity instruments would always be accounted for under FVTPL only. Okay. So first question I'm asking is whether it's held for trading. Yes, it goes for FVTPL. And irrevocable option FVOCI. So if you choose that, if it's not held for trading, then you have an irrevocable option. So one point that I would like to make at this stage is that when I said the equity instrument to by default go at FVTPL, but you have an option to irrevocably classify it under FVOC. But this irrevocable option should only be there when you have not invested in for trading purposes. If you are intending to sell it off in a very short duration, I do not envisage that you would go for FVOCI. The FVOCI should be gone only if you are not held it for trading. If it's no, if you do not have irrevocable option OCI, this is a general consideration over here. Now, when we move to debt instruments, now in the debt instruments, when I said that there are two stages, one is SPPPI and business model test. There is another para in the Ind AS 109 that says that irrespective of the business model classification, it does not use the word business model. I'm just using a general term for understanding that in case of instruments, irrespective of the business model test, if you think that the FVTPL method would be a better representation of your incomes and gains rather than any other model, FVOCI or amortized cost coming into as per the business model test, you can simply go and account it under FVTPL. So you have an irrevocable option again. So if you choose for that option, then you go for FVTPL. Otherwise, the test that we prescribe, first check for SPPPI. If no, go for FVTPL. As I said, if SPPPI is satisfied, go for business model test. If it's for hold to collect, amortized cost, hold to sell, OC. If it's hold to collect and sell, OCI. If it's hold to sell, FVTPL. That was the basic all classification of financial asset. At this stage, one other point would be that this is all the classification. However, one important point to note this particular accounting methodology that we already discussed gives rise to fair valuation gains and losses. This fair valuation gains and losses is impacting your PNL and OCI, and in any case impacting your equity. Hence, when you talk about figures or balance sheets, when you're seeing those figures, they already have an impact of this fair valuation gains and losses. So hey, when you talk about regulatory considerations that we were there in the previous slides, dividend declaration, managerial remuneration, all this have a bearing on what your figures are, how your financials are looking. These all get impacted by this fair valuation gains. Hence, we will discuss that regulatory considerations in detail in the second part of this video, basically. However, at this stage, we will just understand what is fair valuation gains, how those are arising, why are those, they are genuinely arising. It's the accounting requirement that I have to, so that is not something that is wrong or anything like that. The fair valuation gains are there in my financial statement. Treatment of these, we will discuss in the second part of this video. Hope this much was clear. See you in the next video. Thank you.